All right, ready for your summary of all the different types of adjusting entries. Students love this summary, and usually after I show it to them, they're like, why didn't you just show us this to begin with? Adjusting entries. So when we talk about the adjusting entries, we already learned about, the when, the where, right? We learned about that. The when, the where, the why, the how. We've talked about that. Now it's going to just get more to the nitty-gritty of the journal entries. So that's what this summary is for here. Okay, so your adjusting journal entries, we can group them into two broad categories. The first category is called deferrals, and the second is called accruals. Okay, these two broad categories, what they have in common within the categories, deferrals, these are items resulting from prepayment. Items. Let me do it in a different color. Why not? I can use different colors, so why not? So these are items resulting from prepayments. Okay. When the prepayment occurred, we had to delay or defer recognition of a revenue or an expense. Why did we have to delay that recognition? Because we had to in order to be in compliance with the revenue recognition principle and the expense recognition principle. Okay, so let's look at some examples. Okay, so that's what deferrals have in common. So the deferrals that we have seen so far. Prepaid expenses. That's our first one. Now, prepaid expenses can take many forms, right? We've seen prepaid insurance. We have seen supplies. We've seen prepaid rent. Okay, anything we buy up in advance. So those are some examples. Okay, examples. Now think back to the original entry that we made back in chapter 3 when there was a prepaid item. Okay, let's take the example of prepaid insurance. Now let's do supplies because that one we already did. All right, so when we bought supplies, we debited supplies, we credited cash, right? We increased the asset, we decreased cash. That was your original entry. Original entry. Now, at the end of the period, we have to make an adjusting entry. We talked about why that was in our overview. We said that we have to make an adjusting entry to be in compliance with expense and or revenue recognition, right? So here, at the end of the period, so at end of period, at end of period, an adjusting entry may be needed, right? May be needed. So you're going to look and see, of the supplies I purchased, have I used any up? If you said, no, I have not used any, all 100% still remains an asset and you wouldn't make an adjusting entry. But most of the time you've used something, right? You've used some paper, you've used some pencils, you've used some toner, so that you will likely have to make an adjustment. Totally fine. So that adjustment is move to an expense account. The amount that you've used, that increases it, and decrease the asset because now you've used it up. Okay. So there you've got your adjusting entry for a prepaid expense. It could also be done for insurance, right? Think of the original entry when you buy insurance. Prepaid insurance, cash. As you use up the insurance, you put it to insurance expense and decrease the asset. Prepaid insurance. So all prepaid expenses, originally we increased an asset. right? Why did we do that? Because expense recognition said we had to delay the recognition of the expense because we had not yet used it up. So then that means when we have used it, we go ahead and put the amount used to expense and we decrease the asset. All right, lovely. So there were 2 examples there for you of your prepaid expense. Another type of deferral, equipment. Okay, equipment can come in many different forms. It could be a vehicle, it could be furniture, it could be computer hardware, right? Just office equipment. All right, but whenever you hear equipment. So think back to the original entry we would have made. You would have debited the equipment account, and equipment is just a general account used for any of these items. All right. We can also depreciate other things like building, but we're really not seeing that yet. So I'm just going to give you equipment, okay? Trying to make it simpler for you. I know it may not seem like it, but I really am. Okay, so there was your original entry. Same thing at the end of the period, we've probably used that equipment, right? It just being in our office, the furniture being there, it has been used. We have benefited from it. So we have to increase an expense. Specifically with equipment, we use depreciation expense. And that new contra account we talked about, accumulated depreciation. There's your adjusting entry. Okay, and it's always going to be those 2 accounts whenever you're talking about depreciation. Make it a little smaller. Okay, and then your third type of deferral is unearned revenue. Okay, so all of these result from prepayment. Either the company prepays, or in the case of unearned revenue, which is sometimes called customer deposits or customer prepayments, right? Here we actually receive the cash. So your original entry is receiving the cash. Sorry, cash. And we have to put it to a liability. Why? Because we have to delay recording the revenue, until it's earned. To be in compliance with that revenue recognition. At the end of the period, we're going to check, we're going to see, have we earned any? If so, decrease that liability. Unearned revenue and increase a revenue account. So you're decreasing revenue, decreasing unearned revenue, increasing revenue. All right. Something else that might be fun. For each adjusting entry account, remember we said no cash, no cash. Okay, so yes, there was cash in the original entry, but there's no cash in the adjusting entries. Okay, no cash account, no equipment account. You do not see equipment in the adjusting entries. We see equipment in the original entry, but not the adjusting entry. All right. And then the other thing I want you to notice is that you're going to have at least one income statement account and at least one balance sheet account. In each adjusting entry. Okay, so let's go ahead and identify that in each entry we've done so far. So your balance sheet account, supplies. Supplies is an asset. Accumulated depreciation goes with the asset, so it's considered a balance sheet account. And then unearned revenue, it's a liability. Liabilities show up on the balance sheet. Income statement. On the income statement, you see expenses and revenue. So you should have one of each color dot. And that way you know your adjusting entries are in good form. All right, so that was the deferral side. Let's talk about the accrual side. What accruals have in common is they are items that have not been recorded. They have not been recorded. So they are not yet recorded. And they are unpaid or not yet received. Okay, so if you think back to the example we did previously here, right? Unpaid, unbilled, right? We haven't billed it yet. So these are things that we have not either paid in case of wages, or we have not received those customer payments. Okay, let's go ahead and look at the two types of adjustments that you'll see. You will see accrued expenses and accrued revenues. And what's going to be nice about these notes is you'll just have all 5 journal entries in one place, along with some good fun facts, maybe the original entries as well. So it's a really good notes for you. Yeah, my other class loved it. Okay, so let's look at the original entries. It's kind of a trick question. There are no original entries for accrual items because we said they have not yet been recorded. The first time you record these items is through the adjusting entry. There's been no original entry made yet. Okay, so the adjusting entry, it's going to be some sort of expense account that's debited, some sort of liability account that's credited. I leave it vague like that on purpose because you're just going to customize it depending on what you're talking about. So here it was wages. So we did wage expense, wages payable. If we were doing interest, it would be interest expense, interest payable, right? It just depends. So you're just going to have to do some sort of expense, some sort of liability. Okay, that's why I'm kind of leaving it blank there for you. Same thing with revenue. It's going to be some sort of receivable and some sort of revenue. You just customize it based on the type of revenue, type of receivable. So in the example here, it was account receivable, service revenue. If it was interest owed to us, it would be interest receivable, interest revenue, right? Just depends. But it's going to be some sort of receivable, some revenue. Let's make sure all of our adjusting entries, now that we have all 5 here, there's no cash in any of them, no equipment in any of them. Let's make sure that we have one income statement account and one balance sheet account. Okay, income statement, expenses, revenues. Balance sheet will be liabilities, assets. Yay, look at that beautiful flow chart there of work. Keep that handy. That's going to help you with your assignments. It's going to help you study. It's going to help you with your quiz. So keep this beautiful piece of work with you. All right, good job.